Hello and welcome to the State of M&A Deal Making in the COVID area. We have guests across the country that will be joining us today to hear our expert panel, and I would be remiss to not introduce them. So I will start up what would be on my upper right with David Kupetz. He is a partner with Sulmeyer Kupetz and specializes in troubled transactions, crisis avoidance consultation, workouts, restructurings, reorganizations, bankruptcies, receiverships, and assignments for the benefit of creditors. David, you must be a busy man. Thank you so much for joining us. Good to see you.
Thank you. Good to be here.
Thank you. Then, good. Thank you so much. Great to have you. And Channing, on his left, Channing Hamlet, he is the managing director with Objective Capital Partners. He serves as an execution leader for the firm's M&A and valuation practice, and he also leads the firm's business services practice. He brings more than 25 years of experience with investment banking and business valuation to his clients. Channing, great to see you.
Thank you.
Good to have you. And last but certainly not least, we have Konstantin Patamianos, our own M&A and corporate partner with Fogel and Patamianos. He has a wealth of experience that includes buy and sell side mergers and acquisitions, including reverse mergers, domestic and foreign stock acquisitions, as well as asset acquisitions. Welcome, Konstantin. Good to see you.
Thank you, Jerome. Much appreciated. Nice to be on board with Channing and David.
Well, of course. And you know, we have a high-powered panel here. So what I want to do is just give you and the audience an outline of what's going to happen. We have some Q&A with the panel, some questions that are going to be relevant to COVID, to M&A currently. And what I'd love you to do is, as you're listening, if you have a question, go ahead and put it in the chat box. We'll put you up in the queue. We already have some questions lined up. So the last 15 to 20 minutes, we'll take questions from the audience directly, and you'll be able to engage with analysts, one of the best parts of this. And so without further ado, let's go ahead and get started. David, I want to start with you because you know, you're just a renowned expert in bankruptcy and troubled transactions. And I'd love for you to provide an overview. What's the current state of bankruptcy activity? What is that you're seeing here in distressed deals and troubled transactions currently?
Sure, happy to do that. In the context of bankruptcy and distress, right now, in some ways, it's a tale of two sectors. On one hand, you have large companies, and on the other, middle market and smaller. And with regard to large companies, there's those sectors that were already experiencing issues like retail. Everybody knows that retail has been undergoing disruption for a number of years, and there's been an acceleration. So you've had quite a few iconic retailers. I won't try to read through them all, but for example, J. Crew, JCPenney, Neiman Marcus, Brooks Brothers, Lord & Taylor, Lucky Brand Jeans, and on I could go, that have gone into Chapter 11. You also in the energy area have had quite a few Chapter 11 filings in the oil and gas and other aspects of energy. An interesting fallout in the retail context, or not really a fallout, but development that had already been underway prior to the pandemic, is that Simon Properties, the largest small owner in the country, has been working with joint ventures with Authentic Brands in some instances, Leonard Green Partners in some cases, and Brookfield, another landlord, also in some cases. And they were becoming the buyer of their tenants that go into Chapter 11. So some of these large retailers. Last year, even prior to the pandemic, they did that with Forever 21, and now it's been ongoing with Brooks Brothers, JCPenney, and Lucky Brand Jeans. A lot of these companies were over leveraged, and they were really heading towards a restructuring, equity frequently out of the money, and either they do a sale or the debt is converted, the senior debt to equity frequently, or the middle tier subordinated debt. It depends, you know, who's in the fulcrum position based on the valuation of the company. And therefore, most of these Chapter 11s are taking the form of either 363 sales, so sales in Chapter 11, or the conversion of debt and the equity holders, the debt holders becoming equity holders. And some are just straight liquidations. That's not uncommon. It's unfortunate, but it's not uncommon right now. Although most of the names that I said are coming out in one form or another, they're usually reduced versions of their prior self. And on the large company area, before I move to the middle market and smaller, there's also those that have been directly pandemic impacted, that like Hertz, 24-Hour Fitness, Gold's Gym, California Pizza Kitchen, and of course there is severe distress. Obviously, it's obvious to everybody in travel, leisure, hospitality, restaurants. I think Disney, for example, announced either today or yesterday that they're laying off 30,000, approximately 30,000. That's obviously a lot of people. In the middle market, in my opinion and my experience, a lot of the impact of the pandemic has been deferred. Everybody knows about the PPP loans and other governmental programs that have been out there and accessed by many of the middle market and smaller businesses. There's uncertainty at this point regarding ongoing governmental support, both its existence and its scope and extent. So we'll see how that rolls out, and that obviously can have a major impact. I have a client who was that is a restaurant group in the state that obtained a significant PPP loan, and without that would have months ago needed to restructure and or go into a Chapter 11 case, but at this point has avoided that. And whether in the long term that really advanced anything remains to be seen, but they certainly were able to bring back a large number of employees that they had laid off. Now, there may be other issues, because one of the questions becomes, are things just being delayed as opposed to really getting addressed? Landlords and lenders, generally speaking, especially in the middle market, have been much more accommodating so far than they ordinarily would be. And frequently the landlords have had their hands tied in terms of evictions, which may very well not have been in their best business interest anyway, but legally they've been restricted, generally speaking. A lot of tenants are moving towards and negotiating percentage rent deals. I have a client that filed Chapter 11 last month that has a number of locations with major mall owners, with the Westfields and Maceric's and Brookfields of the world. And we attempted through the real estate representative to go to those landlords and make deals pre-Chapter 11. The communication that came back from the landlords was, hey, pretty much all of our tenants are saying they're considering Chapter 11. Our bandwidth is such that you need to be in Chapter 11 before we can even get you to the right person. We think that these types of percentage rent deals are likely to be deals we'll enter, but we're not going to you can't get there with us until you're in Chapter 11. And my client's now been in Chapter 11 for about a month, and it appears that they're going to be able to make deals with each of the landlords, and most of those are now either signed or about to be signed. But it was a little bit nerve-wracking, because ideally speaking, we would have preferred to have those deals in place, in writing, pre-Chapter 11. In terms of small businesses, moving down the sort of size chain of companies, I think there's been a lot of shutdowns. I've heard estimates of 15%, maybe 20%. And that's obviously, to say the least, kind of devastating and very difficult for many people. In terms of another whole area that may have a lot of impact is local municipalities, cities, local agencies, counties, many of which are dependent upon, to some extent or another, and some very significantly, hotel tax. In California, it's referred to as TOT tax and or sales tax. And how that will roll out into the next year is uncertain. And it may create other issues for the economy in general, which is concerning. Now, it's unclear how much government support, if any, will come to the local governments. I'm sure they'll get some. Shouldn't say sure. Most likely they'll get some, but also most likely it's, for many, it may be inadequate. So a lot of uncertainty at this point. At the same time, there are certainly areas where companies are thriving, whether it's technology, other commodity businesses and other things. So it's a very kind of bifurcated marketplace in many ways, both in terms of what's happening between large and small companies, and also in terms of various different industries and how they've been impacted. And it's an environment of a lot of ongoing uncertainty, obviously.
And David, you've set a perfect backdrop, and I just love hearing your analysis. I could probably, listen to you for hours. It's so insightful and full of facts and real case scenarios. And so taking your backdrop, Channing, you being an expert in investment banking, how has COVID affected M&A activity? And can you provide an overview kind of deals and capital structures that you're seeing in the market?
Yeah, just really quickly, I'm Channing Hamlet. I'm a partner at Objective, and our firm does both valuation and mergers and acquisitions work, and we're primarily representing business owners that want to sell, and we participate mostly in the lower middle market, and most of our deals range from 10 to 100 million in value. I think, needless to say, navigating COVID has been an interesting journey with a lot of ups and downs and twists and turns. But effectively what we saw is from February through kind of the middle of June, deal activity really, really slowed down and was probably down by 50%. And then sometime in the first or second week of June, it almost felt like someone turned the lights back on. And M&A activity kind of bounced back right away. And one of the things, I think there's a couple things driving that. When you look at sort of the health of the stock market and the liquidity available both in the public markets as well as the private equity firms, the public companies and the acquisitive strategic buyers have more cash than they've ever had in history. And then private equity over the last kind of 10 or 15 years has really grown very significantly, and there's tremendous dry powder. And so where kind of 15 years ago when we were talking to private equity firms, they were saying, look, we don't like to participate in auction processes. We find proprietary deals. We don't like things that are bid up, et cetera, et cetera, et cetera. Now, most investment bankers that I talk to, myself included, are fielding phone calls and emails every day from private equity firms begging to participate in auction processes. And so there's so much capital out there sitting on the sidelines that's really kind of driving the M&A market. And so we see very, very strong activity right now. And I don't know if it's back to pre-COVID levels, but it's close from what we're seeing. And it's been sort of an interesting kind of up and down. I think it's definitely industry and situation specific. David talked a lot about, some of the industries that are struggling and heavily impacted by COVID. M&A activity has slowed down in those sectors, but in other sectors that have either been not impacted or less impacted, we're seeing really strong interest from buyers and a lot of activity. And our firm has a couple transactions that we're working on right now that are in market. And so I'm talking to between 5 and 10 private equity firms a day. And most of these firms are saying the same thing that I just said, where they're looking for deals, they're very active, and deal flow decreased in April and May, and it's back. I think the biggest challenge that we see that we've been working with our clients on is COVID. I think that COVID had an impact on almost every business and every sector in one way, shape, or form. And so when buyers are looking at deals right now, it's very difficult for them to understand sort of the normalized level of revenue or the normalized level of profit. And, in most cases, in most transactions in the lower middle market that we work on, the buyer values a company based on kind of its normalized level of operating performance. And so we're in a situation right now where you look at the trailing 12 months and you have this period from, March through June or March through current that's impacted by COVID. And so, in representing a seller, you're kind of sitting there saying, hey, yes, Mr. and Mrs. Buyer, I know that my client's revenue or profit is down, but it's as a result of COVID. And, as soon as there's a vaccine, as soon as there's this, as soon as there's that, it's going to bounce right back. And so it's not fair for my client to take the full brunt of the discount based on COVID. And so we've been working with our clients to do some normalization adjustments to understand the impact of COVID and try to get buyers to look at the businesses based on kind of a normal level of earnings. And those discussions seem to be going well. However, I think a lot of deals now are using an earnout or some other structure to kind of bridge the gap so that the buyer and the seller share the risk related to COVID and share the risk related to the recovery. And if you think about it from the seller's perspective, if you own a business right now and it's down and you think it's going to come back in the next 12 months, then you should be comfortable accepting an earnout. And if you earn the earnout, you get the amount of value that you otherwise would have gotten. If you don't earn the earnout, that means that the business continued to struggle and the value is likely permanently impaired, and you still sold it for a reasonable to fair price and got liquidity. And then on the flip side, the buyer is in the same situation. And so we're seeing a lot of scenarios where there's an earnout or some other accommodation for COVID, where both the seller and the buyer feel like it's a fair transaction and it shares the risk of COVID recovery. And just as an example, one of our clients signed a letter of intent literally the first week of March. We were hearing about COVID in the news. I was ignoring it because it wasn't really having a direct impact on me and I was busy. And so we signed a letter of intent the first week of March. My client, as a seller, in his 50s, was super excited. His business was up 50% year over year in January and February and doing very well. He had signed a letter of intent with a buyer that was going to put never have to work again money after tax in his bank account. And the buyer was a great strategic fit that was going to help him grow and build the business. And so we signed that and celebrated the first week of March. And then the next week, when COVID became a reality and the world kind of came to a grinding halt, the buyer came to us and basically said, look, we need to put this whole project on hold and see how COVID impacts the business. And so we waited a month, and at the end of the month with our client, we decided to go back to the buyer and basically say, look, we're fine waiting. However, we would like to still move forward with a transaction. Can we talk to you about adjusting the terms so that it's fair to buyer and seller and we can move forward with the transaction? And so the transaction basically, we worked with the seller to come up with a new pro forma worst case financial performance under COVID and presented that to the buyer. And effectively, we've now agreed on a deal where the cash at closing is based on a good valuation based on worst case. And then there's an earnout that our client can earn over the next 3 years if the business recovers to the trajectory it was on previously. And so our client is very excited about that. And from his perspective, it's exactly what I said earlier. From his perspective, he's taking some money off the table today, and he's sharing the risk of what happens with COVID in his market over the next 3 years. And if things happen the way we think, where the world kind of gradually goes back to normal, he will get the full purchase price he otherwise would have gotten. But if the world doesn't go back to normal and that sector continues to struggle, at least he got some liquidity, and then he's not an owner of this company during a next 2 or 3 year period where it's struggling. He's got a strategic partner to help him. And so I think we're seeing a lot of deals have that type of a dynamic to normalize the results. And then the other thing I'm seeing with COVID is the lending market has retracted a little bit. And so my understanding is pre-COVID, for a typical deal, lenders, for a company that had between 5 and 10 million in EBITDA, you could borrow between 4 and 5 times EBITDA typically. And now my understanding from speaking to lenders is that they're being a little bit more selective, and the lending market is down between 1 and 1.5 times EBITDA. So that's going to have a slight impact on, overall deal valuations. And so I think we're seeing deal multiples are still very robust because there's this supply demand imbalance that I talked about before, where private equity firms and buyers are very aggressively looking for deals, but they're getting a little bit less lender support than they were pre-COVID. And so that's pretty much, in a nutshell, what I've been seeing.
Channing, great overview. Where are the earnouts? I'm hearing and we're seeing, some cases for very strong businesses, e-commerce, 0 earnout, for some businesses 25. There's some people here that are involved in potential sales that are in the audience. What's the ranges of the earnouts that you're seeing? I know that was a great case where you based it off a worst case valuation. What percentages are you seeing?
Yeah, and the example I gave was a business that was fairly significantly impacted by COVID. Their revenue was down 40%, and it's expected to come back. And in our client base across a dozen deals that we're working on, many of the companies we're seeing 0 earnout. We have a really attractive asset or company that we're selling. There's a lot of buyer interest, and if a buyer proposes an earnout, we kind of say no thank you and move on to the next buyer. And so in those cases, if there is an earnout, it's not sort of part of the core value of the business. It's much more a retention tool or an incentive tool for management to stay with the company and outperform. And then in other cases where businesses are impacted, we're seeing earnout being used as a tool to share the risk between buyer and seller. But I would say it's, Jerome, it's a great question. There really is not a one size fits all. It's very kind of situation and fact specific.
No, it makes a lot of sense. I think when you give as a great overview, kind of with David's background, you give an overview of kind of what's happening with real deals and what's the activity like. So to me, it's really fascinating. And now I want to turn to Constantine, because Constantine, you're well versed in M&A. I mean, you've done this in-house. You've done this as an outside advisor. You've been in investment banking. What are some of the current deal terms that you're seeing are being heavily negotiated right now? And how do you recommend approaching negotiations in a market like this?
I will say that a lot of what we're seeing is tied in directly to what David and Channing are alluding to in terms of their negotiations. I think we can kind of drop it into 3 major buckets, and we'll talk a little bit about each of them. And part of it is kind of the execution risk bucket. The second bucket is kind of the risk allocation bucket. And the third bucket is kind of the purchase price bucket. And when I say buckets, I'm talking about deal terms that we eventually see in these deals as we try to move to a closing. And I'm going to approach this kind of contrary to Channing's approach, where he's looking at it, a lot from a seller's perspective. I'm going to counterpoint it and say, okay, we're looking at this from the buyer's perspective. But obviously, if you're a seller, these are all things you need to keep in mind as well, because negotiations are a 2-way street and you got to figure it out. One of the things that we're seeing is increased awareness and focus on contractual issues. If we're doing due diligence of a potential acquisition, we're going through their contracts. We're trying to figure out, the finance guys are trying to line up revenue with what's showing up in the contracts, et cetera. it's a pretty standard process that's been going on for years, but we're seeing now increased attention to this for all the reasons that Channing and David talked about, which is, okay, let's look at their lease. Are they up to date on their lease? You know, are they talking to their landlord about renegotiating any terms? Are they behind on any contracts? All of these things we need to understand kind of pretty clearly if we're acquiring the business. You know, before it used to be fairly perfunctory, kind of check the boxes, make sure everything lines up. Now there's increased scrutiny of not only does everything line up, but how do we expect it to continue to move forward under the current business environment for this business, for the economy as a whole. Also tied into that is the idea of third-party consents. Oftentimes, if we enter into contracts as a business, we're just happy to sign that contract and get the client. You know, and usually we're not necessarily thinking ahead of what happens when I sell this business. Well, sometimes in these contracts, it is either silent with respect to who can assign this, or it says you can't assign the contract without the other side's consent. Well, when we run into an acquisition scenario, and particularly if we're purchasing assets as opposed to purchasing a company's stock outright, we'll say, all right, if we're going to get all these contracts assigned, does the seller have the right to assign everything? Or as part of this transaction, do we need to go ahead and get consents from the various counterparties to get this deal done? Well, guess what? You know, particularly in a environment where people are not able to perform on contracts, that gets harder. Also, it's harder in the scenario where the counterparty may be having its own difficulties, or maybe leanly staffed in the office, if they have anybody in the office, etc. So getting these consents and making sure you understand is part of the valuation. Material adverse change clauses in there. You know, material adverse change says, okay, you know, we're able to do X, Y, and Z, including step out of this transaction if a material adverse change happens to the business. COVID is, I think for many people, a material adverse change. You know, to what Channing was talking about with the LOI, where they thought they had everything smooth sailing, and then all of a sudden this big, huge material adverse change happened, and they were like, okay, how do we deal with this? Channing and his group dealt with it very effectively by saying, okay, how can we bridge this gap? But this is a factor in these negotiations and documents. Also, when you have these changing circumstances, there's another thing that a buyer will often ask a seller to do in this acquisition documentation, which is provide certain representations and warranties. You know, this is the way the business is. This is what we have in terms of litigation. We do not have any claims outstanding. We do not, you know, all these things. And you make that at the time that you're entering into the documentation, or you say you make it effective as of the closing. You know, now we're having people say, hey, we want continuing representations and warranties that this is the case, you know, up until we take over this business, or maybe even beyond that, because circumstances are so flux right now, you know, saying, okay, you know, we kind of understand you said everything's okay now, so we'll assume everything is okay tomorrow. Well, right now, nobody knows what's going on tomorrow. So they're asking for more. And then the same thing goes with respect to termination rights. Once again, you know, and this falls under the execution bucket, because you're saying, if I buy this business, will I continue to be able to execute along the path that I assume, you know, when I'm going into this transaction? And Channing's scenario is another perfect one where they said, okay, we'll hold off. You know, I assume at some point they could have said, if they couldn't kind of bridge the gap in terms of expectations, et cetera, termination rights would kick in, and they would say, look, it's been great talking to you, but we're cutting our losses right now, and we're going to move on to the next acquisition candidate. So that's kind of in the execution risk bucket. There's a separate bucket that I termed the risk allocation bucket, which is, okay, who is undertaking what risk here? And some of these things are tied in, right? Part of it, when we say the reps and warranties that we're asking of them, well, we're seeing people ask for increasingly strong reps, around regulatory risk, around cybersecurity infrastructure, around business continuity plans, around the company's supply chain, if they're dependent on a supply chain. All these problems that we're seeing cropping up as a result of COVID, buyers are looking at and saying, hey, I want some assurance, at least, that the seller is repping to me that these are not problems they're experiencing, or they're very upfront about what they are experiencing. Channing also talked about, and David talked about, how some of these clients are moving forward and able to stay afloat on some kind of government assistance under the CARES Act or whatever, big one being the PPP loans. Well, there's a whole lot of uncertainty around the PPP loans, as we know. Regulations continue to come out from the government side in terms of what is going to be forgiven, what's going to be paid off, what criteria need to be met for all of these things. So if you're potentially looking at acquiring a business that did take this government assistance, you need to also take a close look at what potential enhanced enforcement this business might be facing as a result of the PPP loans or other programs. You need to make sure, okay, in the restaurant business, how can I comfort myself that they're meeting the restrictions imposed by state and local governments in terms of capacity, et cetera. So the risk of increased enforcement is another risk allocation that you need to understand between buyer and seller. Particularly in distressed environments, and David can speak to this as well, another thing that we're trying to figure out is indemnification provisions. In ordinary circumstances, you'll have certain indemnification provisions that say, well, if X happens, perfect example is, if the company gets sued by a third party for something that occurred prior to the sale, the seller will indemnify the buyer for those costs. And there's things around that, but that's a typical provision. Well, in distressed environments now, we have buyers coming in and saying, I don't know if they're going to be in a position to indemnify. We need to figure out some kind of other mechanism where we can be made whole if something goes sideways on it. So they're looking at escrowing part of the purchase price. They're looking at other mechanisms that give them some more assurance, guaranteed by a parent organization, if it's a sale of a subsidiary, things along those lines. And of course, to some extent, to the extent that you can, some buyers are looking to get separate rep and warranty insurance, though I think it goes without saying the insurance companies are a little hesitant, particularly under the current circumstances, to put a lot of coverage there without a lot of exclusions. The final bucket that we need to kind of talk about, I think, is the purchase price bucket, as I call it. And these are all the factors that Channing knows intimately in terms of, okay, how are we calculating what we're going to pay for an acquisition and how we're going to pay for it. Once again, CARES Act and the payroll protection program, paycheck protection program come into play here, because you need to understand, okay, if I'm taking on that liability, am I actually taking on a liability that we're going to have to pay off? Or in fact, is there a high likelihood that this in fact will be forgiven? So we don't need to factor it into the purchase price. Other loans or debt-like items, we go back to the contractual aspect. Are they behind on their payments to people? Are there penalties? How do we factor that in? Are we going to be able to make them whole? Can we negotiate kind of a lower, be it a lease payment, whatever the case is, as part of this transaction? All of that gets factored into into what we're willing to pay for this company that we're going to acquire here. And those all factor into the overall valuation, right? Channing was alluding to where typical, multiple of EBITDA companies were selling prior to this. Well, now with all this uncertainty, I think there's a little bit of a hesitation to go ahead and pay the traditional multiples unless there's a sense that, hey, really this business is going to recover, or this business, and there are a number of cases like this business has actually benefited from this environment, is going to come out stronger from this environment. But in those scenarios, you also need to ask yourself, is this benefit sustainable in the long term? Also very difficult to do, given that we don't know what the long term is going to look like right now. We're making assumptions. And the final thing that also ties into what Channing was saying is, all right, we're making this acquisition. Are we dependent on any outside financing to do it? Because lenders are changing their criteria and what they are asking for, and their loan to value limits that they're willing to go out with to fund these acquisitions. So we need to make sure that we factor that in when we're calculating what we're willing to offer and how much of that upfront we're going to be putting down. That's a lot of stuff to throw out, and some of it may be somewhat esoteric and lost in the details, which we get caught up with when we're negotiating the details of these contracts. But I think it's important to keep in mind, and hopefully it gives a perspective, at least in terms of what sellers are looking for in terms of actual terms, and what buyers are looking for in terms of actual terms, and what sellers need to kind of keep in mind as they're thinking about doing a transaction. I threw a lot out there. I would go back and ask Channing and David to either confirm, rebut, or clarify kind of any of the points that I raised, because they're in the thick of things as well. And I want to make sure I'm not putting something out there that they're seeing differently.
I would just jump in and indicate that in the severest of the distressed end of the spectrum, the indemnification issues that you're raising really compel transactions through a cleansing process, which would either
Right.
be, a Chapter 11, it's called the 363 sale, which frequently can be an asset purchase agreement entered pre-bankruptcy that's then implemented through a sale, oftentimes an expedited sale procedure where the pre-bankruptcy buyer is designated as a stalking horse and the court approves overbid procedure and protections, a breakup fee, and that kind of thing. Or in the right situations, there's a non-judicial process in California, and in many states it's non-judicial, called the Assignment for the Benefit of Creditors, an ABC, that can also be utilized in the right situations to facilitate a turnkey kind of sale transaction. And in some situations, there's acquisition of debt that leads to the takeover of a company, either through foreclosure or otherwise. So those are kind of on the extreme end of the distress spectrum, a little less extreme in the context of what you're talking about, setting up an escrow or a trust. The thing just to keep in mind is, if the seller does ultimately end up in an insolvency proceeding, in a Chapter 11 or Chapter 7 bankruptcy, whatever rights the seller has to those funds will come into the bankruptcy estate. So it's one thing if those funds are really protected because they're really all under the buyer's control, subject to certain parameters, and only go back to the seller under very specified terms. But if the seller really does retain rights to those funds, then those funds are likely to get pulled back. And in terms of transactions and possible clawback in a subsequent bankruptcy, usually a sale is going to be pretty well insulated because there's been negotiation on both sides, and it's usually an arm's length deal. And you can show that under the circumstances you paid fair value. And that becomes the issue for a fraudulent transfer. It doesn't mean that there was fraud, but there's the constructive fraud concept, where if less than reasonably fair value or reasonably equivalent value was paid for assets transferred by a company that was either insolvent or rendered insolvent by the transfer, and that company subsequently ends up in bankruptcy, those assets can be pulled back in. So, you know, that's sometimes the reasons, one of the reasons why, you know, there's fairness opinions, insolvency opinions, all those kinds of things that may be needed if you're doing an out of court distressed transaction. Of course, if you do it through Chapter 11, then you get a nice bankruptcy court order that says, you know, all the assets are sold free and clear of liens, but you're also potentially creating a possible jump ball. You can be protected as a stalking horse bidder and really get a leg up with a breakup fee and expense reimbursement and other protections. But, you know, there is the possibility that somebody may come in and overbid.
Right. And David's absolutely right. I mean, I was speaking outside of the bankruptcy context, and everything he's talked about makes perfect sense within the bankruptcy context and some of the other scenarios that you mentioned. Channing, how about from your end?
You know, I don't know that I have a lot to add. I think that we see that a lot of the terms and issues that you discussed have always been really important in transactions, and I think in a situation where, you know, the outcome is uncertain and we're in the middle of a global pandemic, a lot of the legal issues become, you know, that much more of a focus. But one of the things that that I've always thought and that we work with our clients on are the two most important terms of a deal are, you know, there's the purchase price, and then there's the indemnification, which really, in simple English, is, as a seller, it's how much of the money is yours and when is it yours, because the buyer can sort of claw back with representations and warranties. And over time, we've seen sort of the market move kind of up and down, where, you know, the typical indemnity terms, you know, range from an escrow of between 5 and 20%, and a term of between 12 and 24 months. And, you know, I think pre-COVID, where there was a very strong kind of seller's market, most of the deals we saw had, you know, very low escrow amounts, and very short indemnity periods. And I think we're starting to see people asking for larger escrow amounts and longer indemnity periods during this environment, because there's so much uncertainty. And, you know, I think to the extent there are sellers participating in this call, and or people that are advising sellers, you know, really negotiating hard and negotiating that indemnity is as important as the purchase price. And so we work really hard with our clients to be sure that there are adequate caps and limitations on the indemnity, you know, and we try to get that into a letter of intent so it's fully spelled out before we go exclusive with a buyer. And then the second thing that Constantine mentioned, which is really interesting, is there's a sort of a newer insurance product that's sort of become more and more popular and moved its way down to smaller and smaller transactions over the 5 years. And you can buy insurance now for the representations and warranties. And that's often a really elegant solution in that the seller doesn't really have to deal with the indemnity. It becomes an insurance company matter. And when you think about a seller that is going to have to work for the buyer, or in the case of a private equity firm, co-invest with the buyer, to the extent there's an insurance on the indemnity provision, it makes it a lot easier for the seller and buyer to work together in the future to the extent there are representation and warranty claims. And so it's a great product and it's a great solution. I think in deals that are sort of 20 to 30 million in value and up, we're seeing it in 75 or 80% or more of the transactions we work on at this point.
That's great.
This is great. I got a couple questions. Love the discussion, Constantine, and kind of getting David and Channing's feedback. I think that gives it an excellent, well-rounded feel to it. One question that I have two questions. One that came in was recently CEO John Mackey said that his company's merger with Amazon was like a marriage. You got to take the good with the bad. So I guess questions to you is, what's your take on post-merger integration, and how as a seller can you look out for red flags from buyers, and how as a buyer can you look out for red flags from sellers, or even in David's case, maybe bad stalking horse bids or things like that?
I can take a shot at that. I think one of the things, in our market, most of our clients are closely held, where the owner is running the business and it's their baby.
Mm-hmm.
And a big part of running a sale process is allowing the seller to interview multiple buyers, so that and most of our companies, and this is sort of a play on our firm's name, most of our clients have differing objectives. They want to get obviously the best, the most money, but often they're looking for finding a buyer that's going to treat their employees well, treat their customers well, be a good steward for the next generation of the company, et cetera. And so a big part of the way we run the process is we allow our clients to meet with and interview buyers. Frequently, in the case of private equity firms, our clients will check references. Our clients will check references and really be careful about who they pick. In many cases where we've run a competitive auction and we narrow down to 2 or 3 bidders and really are able to bid the price up, in many cases our clients are not always picking the highest price. They're picking the best fit. Price is good enough and they're picking the best fit. And so I think a lot of the sort of post-merger integration is getting clear as a seller on what you want before the transaction, and really being careful about qualifying the buyers and make sure they're going to be easy to work with and meet your objectives. Like, I think that's a big part of having transactions successful post-closing. And as an investment banker, we're often not involved heavily after a transaction closes, but we do stay in touch with our clients and kind of keep up with them and how they're doing with the buyers. And in many cases where there were some questions about whether it was the right buyer or not, and our client decided to ignore some red flags, in many cases, in hindsight, that was a mistake. And in many cases where our client maybe really did spend time picking the right buyer and understanding their culture and the plan and being a little bit more deliberate, often you don't see any post-merger integration issues because the plan was well thought through and everybody went in eyes wide open.
That makes a ton of sense.
That's a great answer. Did David or Constantine, anything you want to add on that? I think that was a beautiful answer as well, but any thoughts from your perspectives? One question here we got from Keith Detloff, who's here. He said, we seem to be back in the roaring 20s again. He said, if you're starting new, what are the best expectations to set around funding? Standard investment versus rolling funding, et cetera.
I'd be happy to talk about that one as well, David or Constantine.
Sure.
Yeah, I wasn't around in the roaring 20s, so I can't speak personally to that, but it does seem like we're in a, very robust deal and investment environment, and, investors that I talk to, other investment bankers, attorneys, et cetera, everybody seems to agree. So knock on wood that it continues. I think the funding strategy question about sort of, raising money now versus raising kind of rolling amounts is really situation specific. Most most of the time it makes sense to raise a little bit more money than you think you need so that you can comfortably hit a milestone that gets you to a valuation inflection point. And so maybe taking a little bit more dilution and raising a little bit more money than you need is lower risk. The rolling funding thing is often tricky for companies, and I've seen companies run into trouble where they bring an investor in and the investor has commitments to invest over time. And as soon as the company hits a hiccup or a bump in the road, the investor pulls the plug. And that is the absolute worst time to go and find another investor to replace. And so that rolling funding strategy, I've seen it backfire a number of times where on the surface it looks great because you're taking less dilution, you're only using the capital you need, but it does come with risks attached.
So I have a couple of caveats to add to that, which is in all the time I've been doing this, I have yet to see a client regret taking more money than they needed at a decent valuation at any given point in time. So I normally tell people if there's a decent deal on the table, take it, because you don't know what tomorrow brings. Company could have been looking to raise money in Q3 of 2019, knew what it needed, was planning on going back out to the markets in Q2 of 2020. Guess what? You know, that would be a difficult thing. But obviously you can't sit there and foretell that. So it's a balancing act in terms of what you take when. But the flip side of that I've also learned is that raising capital is a time and resource intensive activity that generally involves multiple members of a company's management. And during that time, when they're actively fundraising, be it in the private markets or the public markets, I've generally seen the eye come off the operational ball at least a little bit. So the less that you're out there raising capital regularly, the more you can focus on improving and growing the business, in my opinion. David, Channing, thoughts?
Well, the situations that we frequently see are situations where companies need to deleverage because they've taken on too much debt. They're over leveraged. Now, we recognize that's hopefully a relatively small minority of the overall deal flow that came in, but those are the ones that end up in our world in terms of distressed and restructurings and workouts, and we try to get those restructured out of court when it's feasible, and only resort to doing it through a insolvency process, through a Chapter 11, for example, when it can't be done out of court. And one of the problems that we run into in the distress world is frequently companies are either in denial or otherwise not ready to deal with their situation when they turn into a distressed environment, or they have challenges until their options are more limited. So in the distress world, one of the things we always lament is just that clients frequently aren't as proactive as we'd like them to be in bringing us in and or having other advisors assist them soon enough where they have the option of working things out outside of court.
And to David's point as well, it's worth clarifying that I was really kind of referring more to equity financing and not debt financing, because he's absolutely right. You know, companies do get in trouble by over-levering themselves, where just making their debt payments overwhelms their business.
Yep.
And I have one follow-up. You know, David, you and I have had conversations before where, you know, there's red flags you can see for companies that are mismanaging things. Like, for example, I'm hearing stories of, you know, not just secondhand, but stories of business owners, you know, misappropriating funds, misappropriating PPP, not paying payroll taxes. And we've had conversations before about red flags like, you know, when accounting people start to leave company, could you share some of the red flags from your experience of, you know, when you need to pay companies are doing things that you should pay attention to?
Sure. I mean, well, one of the things to avoid is not communicating with key stakeholders. So whether you call it a red flag or just a major mistake is frequently if a company starts to turn towards a troubled environment in terms of how they're doing and they're not performing, it doesn't help to hide it from the key stakeholders, because frequently it's going to come out anyway. And if they lose credibility, the ability to work things out and resolve them, it just becomes more difficult. And so there's maintaining good communication, which is important. As a result, maintaining credibility, providing accurate financial information, projections, and if the company starts to cut because they're suffering on a liquidity basis, accounting personnel frequently that ends up making it more difficult to actually provide timely financial information that they need to particularly be providing at that point in time. So, Jerome, you're focusing in that regard on a very important area that's kind of intertwined, because it ties into the whole communication aspect, it ties into the credibility, and, you know, being able to resolve something with your lenders, with your other key stakeholders, whether it's suppliers, landlords, others, outside of court. If you're in default, it all depends on reaching agreement. You can only do it consensually if you're in default of your agreements with the counterparty. And you have a much higher, as a company, opportunity to do that if you have maintained a certain level of credibility and maintained communication, as opposed to the opposite, which it becomes much more difficult and problematic.
Yeah, those are wise words, and I think it's just general, just obviously always communicating well, but being adequately staffed for kind of what's ahead. So we're wrapping up here. This hour just really blew by. I want to thank you, each of you, David, Channing, and Constantine. I know you're extremely busy people, so appreciate you coming on and having this discussion. Those of you that are watching, we'll get a recorded version of this webinar out that you can circulate to your colleagues. A lot of great information here. We'll also have Channing and David and Constantine's contact information if you want to contact them regarding any of the services that they provide. These are really amazing people. I highly encourage you to reach out to. So I want to thank you for attending the State of M&A Making in the COVID area. It's been a really good one. We look forward to seeing you again soon. Thank you so much.
Thank you, Jerome. Thank you, guys.
Thank you.